Good morning, everybody, and welcome to today's edition of our weekly market analysis session for Feb 13. My name is Carl Kapling. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all the key market moves from last week and have a look to the week ahead. My promise is we're going to look at all the charts you need to know about. Let us kick off with a bit of an introduction to today's session. First, we'll look at crypto markets, mainly Bitcoin, Ethereum. Actually, I haven't changed that from last week. We won't be looking at Avalanche and Phantom, but I do have one crypto you should know about. We'll look at stocks from Australia, China, and the US, as well as the major metals and energy commodities, along with all the key moves in the bond markets for the week. We'll change gears to some Forex and then have a look at the various economic data from the week and also have a look at the week ahead. Let us kick off with crypto first. It wasn't a great week for crypto. We had the SEC reach a settlement with Kraken regarding staking in the US. Kraken is going to withdraw that service, and there are fears that other providers, for example, Coinbase, may have to follow suit. We did see Coinbase shares plunge during the week. Staking is worth about 10% of their annual revenues. What is staking? Well, the old version of crypto was get a bunch of computers together, get them to bash away at an algorithm, and once they solve that algorithm, they validate the network. That is current transactions and all the transactions that have come before that. Of course, they get a reward, the proof of work validator reward. Proof of stake a little bit different, less energy intensive. You don't need to bang away at the algorithm, but you do need to have skin in the game. So you own the crypto, you stake it, and depending on the mechanism, the protocol, various stakers are selected at random to receive rewards. But the idea is you need to be online, have the computers plugged in, and that helps keep the network moving along. Now, stakers obviously receiving a reward from that. The SEC, their claim is that by putting those assets or staking those assets and earning a yield, which is what you get, it is akin to a term deposit. Obviously, if you're going to be offering term deposits, you need the correct licensing and the correct disclosures to clients, and that has not been happening across the industry, and that is what the industry is fearing at the moment. Of course, if you do take staking away from stakers, it makes crypto less attractive in general, and that's why we saw prices fall across the board. It wasn't just, however, your proof of stake mechanisms, for example, Avalanche down 10%, although they were severely adversely impacted, but also your Solana there down 10.8%, Cardano down 6.6%, but your proof of works like Bitcoin also down 5%, but let's face it, a more modest decline. In terms of the fear and greed index, we're at 50. I would have thought it would have been worse. It certainly feels worse than that if you're hodling a bunch of crypto that is down from last week's 58. You can see we're just starting to look good. And that's the frustrating thing. You look at the monthly gains there, and they've basically been cut in half. We were starting to look good. Bitcoin, challenging 25,000. That's not happening anymore. We're potentially going back to challenge the 20,000 handle. We're down around the 22,000. The rumors broke around here in this candle. That is Thursday's candle, and then this is Friday's candle. It happened early morning Sydney time if you're Sydney based, and the problem is we haven't seen a rally, so you've seen sort of the Saturday, Sunday, and the early Monday candle there. Big fall, no rally, not a great sign. It says that unlike many events in crypto where there's a bit of a pullback and we get a handle of what's going on, the buying comes back in, you go up, make new highs. It's telling you that the market didn't like that, and they are reluctant to come back in with demand. And supply is still very strong, even if the demand is there. Maybe it is there. The supply is certainly strong enough to keep a lid on that demand in terms of its ability to impact upwards price movement. Okay, so where are we now? Well, we had that wonderful short-term uptrend that we're enjoying. The consolidation phase was broken beneath, really, the bottom of that consolidation phase. We are moving to a more neutral trend in the short term through the traffic light system. That's not a good sign. In fact, as we go through the charts today, have a look at how many short-term uptrends have gone back to neutral. And we're hoping, there's that word, that the long-term uptrend, which was so good at keeping a lid on prices in the past, we're hoping that it will act as dynamic support. That's the theory. When you get above it, and we go to amber, the hope is that it starts to act as dynamic support and we get a bounce and push back off it. That's what we need to watch out for now. It's pretty straightforward. A break below 23.84, it's not looking good. If we can hold here and push back into 23, 24, we're starting to look quite good. And obviously, if we do break above 25.208, the bull market has begun. In terms of Ethereum, very similar theme here, but what is clear is how well the long-term downtrend ribbon, that's dark pink zone, has impeded price action to the upside. And we can see here it has actually started to support, but the breakdown there with the short-term trend change is putting Ethereum on very shaky ground. Below 1400, I do have dire concerns about this, the ongoing sustainability of that uptrend. I did promise you we'd have a look at one crypto I said that you quote unquote did need to know about. It's Lido. So these guys, they have an alternative, I guess, to the centralized staking of your crypto, which is done through your exchanges like your Kraken, your Coinbase, your Binance, etc. So this is a decentralized autonomous organization, your DAO there, that allows you to stake your crypto in a decentralized non-custodial environment. Also has a wallet attached to it as well. It is the main Ethereum staking platform. So there's about $28 billion worth of Ethereum staked. About $8 billion is on this platform. I don't know if you remember way back when FTX went under, I came on here and I said, hey, I think you should buy Trust Wallet. Of course, Trust Wallet is the decentralized non-custodial wallet. That token went through the roof. Early signs are not a lot of interest here, but keep an eye on it. So I'm going to go as far as keep an eye on it. If it starts to move, it's probably worth putting some risk on that one. And what does start to move? Well, you can see those shadows up here around about 280, but I think if we get a close, not just another move there, because we may well see it get beaten down again, but if we see a close above 280, I think that's your sign to add a bit of risk and see where that one might be able to go. Okay, switching gears back to stocks, we're going to have a look at the volatility index. Volatility is going down when, probably put it the other way, stocks tend to go up when volatility is going down. The stocks tend to go down when volatility is going up. We did see it move back up to the upside by nearly 12% as the NASDAQ faltered 2.4%. But as we look further across the risk off spectrum, the S&P 500 and then the Dow Jones, which is your key big blue chip defensive companies, we're only down 0.2%. Hang Seng down 2% in Asia. Nikkei bucking the trend, they're up 0.6%, and Europe generally lower. But the key theme from that screenshot is that riskier stocks were hit harder, and that's not good for this thesis that I have that we are entering a new bull market, fingers crossed. What I'd like to do today is feature some of these Chinese charts. Again, what I try to do in these sessions is show you all the charts that you need to know for the week. Now, if China is going to be this great miracle in 2023, have this incredible post-COVID rebound, it'll show up here. And of course, that will then impact the commodities we're going to look at today, and of course, many of our Aussie stocks. So far, so good. If you're looking at the Shanghai composite there, and these are the stocks international investors can buy. So the international investors' ability to come in and trade Chinese shares. So international confidence in that Chinese recovery. We can see since October, when Beijing started to start the rumor mill, sent out some rumors out, unofficial rumors initially, that some of those COVID restrictions were going to be eased, and then they started to present packages, support packages for their property sector. That sparked the rally, and of course, the broader global risk-on rally through January helped. I think it's okay here, nothing to worry about. I think that's the message. Long-term trend has transitioned through the traffic light system back to orange. It's supporting prices for now. That is very important. And the short-term trend looks very, very strong. The price action is lower peaks and lower troughs, but with a pretty decent candle here. Going to call that the pullback it had to have into support. So all good, happy days there. But then we go to the shares that only mainland Chinese residents can buy. So I just flick back. These are the shares that anybody can buy. These are the shares you need to be a Chinese citizen to buy. And what we're seeing here is international confidence in the Chinese rally, and then local confidence in the Chinese rally. And I'd put to you that the local confidence is far less. And that concerns me. Look, technicals we're still holding, but the candles are far more bearish. And this pattern here is looking far more similar to this pattern over here. Okay, we can see what happened after that. So I think you need to keep an eye on this. So putting a pin in this one for now. We'll continue to watch it over future Monday sessions. But if we were to break, say, below 13.2 on this, I don't think that's a very positive sign for this idea that 2023 is going to be the year for the Chinese economy. And the other two I'd like to look at are just a couple of real estate sub-indices. So obviously the real estate market is the huge driver of growth there. If these break down, it tells you that despite those support packages that Beijing has put forward, which is mainly around about extending companies' ability to pay down debts and supporting them on, reducing debt or in some cases taking on more debt, it's not exactly stimulating demand. It's all about trying to stop some of these zombie property companies from going under. If this breaks 5,800, I don't think that's a great sign. You can see it's pushing off that long-term trend. And here, I think this one's breaking. It literally is breaking right now and probably reflects that A50 shares more closely. That's the Hang Seng Mainland Properties Index. So, sounding the alarm there, keep an eye out for those charts. In terms of US equities, switching gears again, we can see that the Dow Jones Industrial Average, this is our value trade, this is our defensive trade. It's not that we don't want to see this go up, but when it does go up at the expense of the NASDAQ, it means that investors are becoming more risk averse. It did have a better week than the NASDAQ. We saw it was still down, but a little bit concerning that that is doing better. The trend is very flat there. No further comment required. Far more interesting is the S&P 500, and that it is pushing or pulling back to the both the short and long-term uptrend zones, which the theory is once you get above them, tend to act as dynamic support. We can see how well they resisted prices on the way up, and we'll see. We're going to get an indication this week's going to be a big week in data. And hopefully the data falls the right way, and we do see some white candles and some lower shadows put in this zone, and that will change the whole, I think, psychology of this fledgling rally into something that may drag in some more FOMO and push us to higher levels again. And for me, really confirm that the US bull market began in October. NASDAQ Composite, probably even more important because it is that key risk on gauge. It's very similar here to the S&P 500. Short-term uptrend is coming under pressure. Long-term uptrend also under pressure. And the hope is that we see support here. Where does the thesis go wrong? Just back on the S&P 500. Look, I don't want to see it close below the 4 handle. I think that would tell me that there's just too much supply in the system for that bounce to play up. And similarly, I think below 11,388. The NASDAQ is in some trouble there. Having a look at the Russell 2000, that probably looks, well, I was going to say probably looks the better of them. Maybe the S&P 500 is the better, but it is doing better in that it got quite a long way above its long-term uptrend zone and appears to be well supported at this point. Your bug out point for the Russell's probably beneath that peak there. I'm going to call it about 1840. Okay, let's have a look at the major metals markets. You can see there, very consistent move to the downside, particularly aluminium, nickel, tin, and zinc. Copper was better. I know there are plenty of copper bugs that do watch this presentation, but still down on the week and bucking the trend, just iron ore. And ironically, iron ore, a key component of that Chinese property picture for 2023. So we can see, stocks are under pressure, but in terms of that is Chinese property stocks are under pressure, but the iron ore price is still strong. Is it changing trend here? I think there's a possibility. It's one of those short-term uptrends going back to neutral. Long-term uptrend, we're hoping it will be supported, but a little bit concerned about the price action taking out, say, that little trough there. Too much pressure on this here. So far, so good. The candles aren't terrible. But let's say 118 is really firming as that key level now. I think we got this trough here, a close beneath 118. It's telling you that this trend is turning, and we're going to see some serious pressure put on that long-term uptrend. Of course, that has ramifications for your BHP, your Rios, and your Fortescues. Having a look at copper, I know copper is supposed to be the next big thing, the next lithium perhaps, and we're getting pretty excited up here to 436, but then I saw this candle and I said, look, probably overextended, probably going to take a pullback into support around $4. It has happened, but it hasn't happened with some very nice candles. I was hoping for some white candles in and around this zone, some lower shadows. We've barely seen it. In fact, really, it's the black candles that we've seen. So that gets me quite worried. Obviously, it's going to trade inverse in many respects to the US dollar, and we know that there's going to be some US dollar strength ahead. Well, we will when we get to the chart. So we could see a little bit of an overshoot here, maybe even 390 tested. I don't want to see it get very far beneath that zone because it will be changing, therefore, this long-term trend as well. But look, I can go a very tentative hold on that, but having said that, fully expecting a little bit more downside before it has any chance of picking up. I think nickel's intact. I wouldn't say it's the best looking chart, but it's not the worst either. We're looking for cues here as to whether markets are positioning for strong global growth in 2023 or they're positioning for a recession. I think the jury's out. Jury's becoming more and more convinced, I think, that the lithium carbonate trend is turning around. So for the lithium bugs out there, the true believers, the faithful, I think there's some problems here. It was we saw the thermal coal price change in a very similar way. And I do think that this long-term trend on lithium carbonate prices are changing. We haven't seen the lithium hydroxide price change just yet. And of course, this is further up the value chain because you can process your lithium carbonate into lithium hydroxide. Lithium hydroxide is more akin to what your EV battery manufacturers are looking to buy. But it's not exactly pushing to new highs. And we've had such a long period of consolidation where, supply has been able to catch up to demand and meet that demand that were causing prices to go sideways. I think it starts to break into the low 70s. Then I think you're going to see some problems for your lithium stocks. Have a look at gold. I know we've talked about things that are getting people excited. Certainly copper, certainly lithium and gold actually through November, December got people very excited. I was in the media, I think a couple of Fridays ago, and I said, based upon this candle here, I might have said it on Monday, that I think you need to take some profits on your gold stocks, reinforced by this candle here. And I said, if we don't get the white candles coming in very quickly, if we get the long upper shadows coming in this zone now, that's not looking good for gold. And I do think we are seeing the signs here, the technical pattern that gold will continue the downside. Is it a species ending event? Well, it could be, because look what happened here and then reinforced here. But we will think, I do think we will see some further downside. 1825 is the point I think you can get to. And then let's see how the candles go there. That's where the long-term trend is. And if we can see a strong performance put in here, white candles, long lower shadows, we could, well, be looking back in a few months and say, well, that was the point to buy. It was a technical pullback in a new bull trend. That was where X marked the spot. But I do think we're going to get to 1825 on gold. Crude oil surprised a little bit last week. There was some news out there. Russia did cut their output by 500,000 barrels a day. So market responded positively to that. Well, positively is 8.5% to the upside on West Texas, almost as much as that on Brent. We finally saw a bounce in natural gas. Natural gas prices still down about 40-50% over the last few months. Aussie dollar was flat as the US dollar index more broadly was higher, and bond yields, that's the big one on screen there. Everything pales into comparison compared to a 30 basis point increase in Aussie 10-year bonds and an 18 basis point increase in US notes. So we will often speak about how the Reserve Bank and the Federal Reserve are raising or cutting rates, and they tend to be moving at the moment. In both cases, around about 25 basis points. We saw pretty close to that in the US. That is the market applying an interest rate hike, and then much more than that even in Australia, the market applying an interest rate hike based upon some of the data and some of the commentary from central banks. We'll get to that in a second. First, we'll look at coke and coal, and this is the chart you kind of need to look at with iron ore, and it is heading higher. So I think your Stanmore Resources, your Coronados, I think they're fine. I know I keep saying that. I'm a broken record. Been saying it for, well, many weeks, if not months now, on the basis that this coke and coal chart is turning up along with that, China growth story. But hey, I think you need to stay on your toes, because we did see in those Chinese charts some signs that story might be losing some steam. Losing steam, if you're one for the puns this morning, I've got them all, is Newcastle thermal coal futures. A little bit of a ebb and flow as it declines, but I do think that trend is over. And again, have a look at this chart and go back and look at that lithium carbonate chart. I think there are some similarities. Looking at some natural gas charts here, seems to be flattening out a little bit on the European natural gas and maybe flattening out a little bit on the NYMEX. I can't see that 7% gain, but it's off such a low base. 144 is the key level. That's the June 2020. So just after the COVID crisis broke, and really we were all locked down, and there was very little use or need for energy products. That was the low. I think if you get down there, that could be an interesting place if you see the right candles. So white candles, long lower shadows, to maybe put a bit of kamikaze risk on this. And I say it's kamikaze because the trend is so well established to the downside, but it can go further. So don't look at that chart and say, oh, it's going to bounce. You know, things can go down much more. And yeah, look for the candles, look for the key levels. I think we're still in a bit of an intermediate zone here. I don't think there's necessarily any of those other ones, say 223 or 179, that are so significant. Have a look at uranium. Well, let's skip this one. Not a lot to look at there. Did pull back during the week. It's very flat. US dollar index is worth looking at this for your commodities traders out there, because if this goes up, your commodities are going to be under pressure. And I do think it's going up. If it's the beginning of the next bull market here, I can't say. But I think we're going to see 105, maybe even an overshoot to 106 before maybe this long-term trend kicks in again and pushes it back down. We get the possibility of a roll. You're going to have to watch the candles very closely, and they're black candles, upper shadows. That's where the trend will end, or the short-term trend will end. White candles in here, and we're going higher again. Obviously ramifications for gold, obviously ramifications for commodities, obviously ramifications for your AUDUSD, which is going to move inversely. And if that 106 overshoot plays out, we're probably going to see 67.5, maybe 67.8 here on the Aussie dollar. And again, very similar to the gold chart. No surprise there, setting up, I think, with the candles and the price action for another move down. Why? We've talked about what's happened during the week. Now we need to talk about why it's happened, because the why is all about bond market. It's all about interest rates, all about the price of money. It always is, it always was. And as I said, 30 basis points to the upside on the Aussie yields, and that's because of the RBA commentary. We'll talk about that during the session there on macro. US yields, just showing you pictures here. So these are the pictures you need to know about. US yields heading back up on the 2s and on the 10s. This is not good for stocks. This is going to erode confidence in the riskier end of the market. It increases your discount rate, which reduces your valuations. And if this was a stock chart, you'd probably buy some, because it is bouncing very nicely indeed off that long-term trend. You know, higher swing lows here through 332, 333, and some monster white candles with shallow pullback, high peaks, high troughs phase again. Let's hope for your risk on traders it hits 394 and then comes off very quickly from there. If it pushes through, you could see the NASDAQ have a very sharp sell-off indeed. Yield curve, all important yield curve. Great predictor of recessions when it's inverted. That is, we've got higher yields in the short term than the long term. And of course, the theory there is that rates are getting forced higher by central banks, but at some stage, the economy is going to slow and that we'll have to cut them, so that in the longer term, yields tend to be lower. Has been a very accurate predictor of recessions in the future. Maybe this time will be different. Let's hope. In terms of where it is relative to the recent past, this orange line was way down here last week. Go check this. Go check the tape. It's now pushed up to be, in some cases, the highest it's been in 3 months. Not really well, it's always the fault of this person on screen, but I felt his interview there with the Economic Club of Washington wasn't so hawkish. He mentioned the disinflationary process has begun again. He said that the fight inflation will be bumpy. All the stuff we knew from the Fed statement the week before. Again, this is me reading between the lines, but 5% I think is firming as that point before they even considered pausing. Inflation fight still takes precedence, and some jobs will be lost in the process. It is a good thing that the labour market is so strong, and I think this is important here. He said his view on wages are moderating, or his view is that wages are moderating. So I don't think anything too negative in those comments from JP. Having a look at the other data out during the week in the US, consumer confidence is probably the main one. That did edge higher by 1.5 points to 66.4 for Feb, but looking 3 bullet points down, the outlook remains cautious. The expectations of index actually fell 0.4 points to 62.3. Cooling inflation and a strong jobs market cited as the reasons for improvement. I should say that 66.4 is the best reading since January 2021 and better than the 65 economists were expecting. 40% of respondents, however, believe employment will deteriorate over the next 12 months. That's up from the 25% last Feb, and inflation expectations did move higher as well. And that's probably what the Fed will be looking at then, and probably also what sent the bond market higher on Friday. 4.2% now, up from 3.9% in January. Bringing it back to Australia, the Reserve Bank did increase rates by 25 basis points. That's not why our bonds went up 30 basis points. That was factored in. It was all about the commentary. It was as expected. Some were predicting 40, and that's on the back of our red hot December quarter CPI data. So we have been seeing interest rates rising since that print. We were at 3.57 before the CPI data, the terminal rate, and we're at 3.95. So you can see this, almost 40 basis points baked in terms of higher rates since that, and we saw another, nearly, in fact, 21 after the Fed minutes. So that's Fed minutes, RBA minutes. Okay, if local interest rates are heading up by 30 basis points, if markets are saying, hey, we're expecting, another quarter basis point increase from the RBA, we weren't expecting, stocks invariably have to go down. And that's why we saw for the first week in many, many weeks, I can't remember a week when all sectors in Australia went down. And that is a little concerning for your bull market hopefuls out there when everything goes down, because I guess the hallmark of this rally from October has been there's always been a sector where, whether it be resources probably or financials next probably, even when those sectors have taken a breather, something has picked up the baton and helped boost the index. It might have been tech. It was probably discretionary. It might have been healthcare. Even your staples have had a really good rally. You can see those 1 month gains there. This week was different. Everything was down. So that is somewhat concerning. In terms of the technicals, 73.76 is probably the key level from here. If we crack beneath that, then 72.57 is the next logical point. I do think we'll see 73.76 come in as the demand point, however, and we're watching for white candles and long lower shadows. I don't like to prognosticate. I will wait and see what candles we get in there. White candles, long lower shadows. It's just a pullback. Don't panic. And we're going to go back up. We're probably going to test and crack those highs. If in this zone we only print black candles, we print upper shadows, we're going lower. And that's when you start to factor in your 72.57 or even a 71.68. Market breadth is concerning. You can see it has really broken down from last week. And that's because of, I guess, the unanimous move to the downside. And that clearly has to significantly adversely impact market breadth. So no surprise there. It's because there's such a broad-based move to the downside. Are we in bear market territory? No, nowhere near it. We're still more on the side of a bull, but yeah, let's just say plenty of damage has been done. And not really reflecting in the trends, but I probably could have gone neutral on a few others and maybe down on some. I just gave some of those uptrends the benefit of the doubt. But energy, short-term trend is very clearly set to the downside. That long-term trend is being challenged. Discretionary is one I almost went from up to neutral. Gold, I did go from up to neutral. Technology, I did go from up to neutral. And utilities, I went from up to down. Long-term trends largely still intact. In terms of where the value is in the Australian market, we're at 14.8, so pretty much bang on that long-term average of around about 15 for fair value. So what we don't have working for us, potentially as we did back in October, November, is that the market was really cheap, and we got to around about low 14s, and at the start of the year we're at 13.6. We're not looking as cheap. We're not looking expensive, but there are far fewer bargains out there to go after. So we'll see some value-based fund managers just pull back their demand. Discretionary sector moving back to the quote-unquote little bit more expensive side there at 20.1 after its strong rally through January. Energy still looking the cheapest, but cycling massive bumps in earnings. That 7.8 will gravitate more towards 14.5. Financials back on the, I guess, more expensive side of things, 13.7 versus long-term average of 13.3. Healthcare, I keep saying it, it is, I think, one of the more, if not the most expensive sector in Australia. Information technology, about fair value. Materials, getting close to fair value. Property trusts, getting close to fair value after its recent run-up. Staples, I would say, starting to look somewhat expensive. Telecoms looking substantially expensive there, and utilities still looking a little bit cheap, but it's a very small sector. Okay, let us have a look at the upcoming events for this week. We do have the Westpac Consumer Sentiment Survey coming out tomorrow, along with NAB Business Confidence Survey. We've got two speeches from RBA Governor Lowe, although one of the people on ThinkMarkets desk said that Friday might be cancelled, so double check that one for me. But Philip Lowe speaking on Wednesday there at midday Sydney time, inflation expectations on Thursday, along with our unemployment data. Looking abroad, it is going to be a busy week. Unemployment data for those who trade the sterling on Tuesday. We'll get some European employment and GDP data also later that evening. A little bit of data there in China for direct investment, probably no big deal for markets, but then looking to the big one, which is going to be US CPI, so Consumer Price Index, consumer-based inflation, looking for 0.5% gain month on month. That compares not very favourably to the 0.1% decline. That'll be mainly to do with gasoline prices, I expect, because we're at 0.4% for the core, a smaller gain from the previous 0.3%. And we're looking for the annual CPI to moderate further to 6.2%. We then have some similar CPI data for the UK and retail sales, Empire Manufacturing, State Manufacturing Index. For the USA, we've got President Christine Lagarde speaking there, ECB President, and the NAB Housing Market Index, so some US housing data there with building permits and starts, and closing out the week with the US wholesale inflation expecting the core to rise 0.3%. Well, that's it unofficially for me today. Just a reminder that Ask the Expert sessions are up and running, and that's a reminder to myself to put out the invites for the new sessions we're going to run this week. So on Thursday this week, I'm going to do Forex, commodities, indices, crypto. Tune in, ask me questions about those, and I'll give you my best technical and fundamental reader. On Friday, I'm going to launch the US version, so bring your US portfolio along, and I'm sure we'll have a bunch of fun looking at those charts. But Tuesday, tomorrow, is the ASX edition, so head over to that link there, register your interest, and you'll be able to join in the session and ask me questions. If you're not a client of ThinkMarkets, well, you should be, because we are the good guys in the Australian broking scene. We've got all the products you need to trade at $8 flat rate, HIN, chair sponsored. Now, there might be a cheaper rate out there, but I can guarantee you they will not have the customer service and the ability to access us, because I do shadow shop brokers in Australia. I tell you what, customer service is the key. And when you're waiting a week for a response and you can't get through on chat windows, and they don't even have a phone number, it is worth paying a few bucks extra per trade to get the service that we offer you. If you'd like to trade CFDs, you can do that with us commission free on our ASX and US shares. If you're looking to get into US share trading, this, I believe, is an excellent way to do it. 4,000 CFDs, FX indices, commodities, crypto, futures. So a lot of stuff we talked about today, that stuff you can trade with a ThinkMarkets CFD account. And just reiterating their award-winning broker, amazing platforms for you to trade, and dedicated account manager with 24/7 customer support. If you like what you've seen today, hit the subscribe button to stay notified of any of my future updates. And if you like what I'm doing, make sure you smash the like button. So I'll continue to do more of it. Apart from that, it has been a pleasure chatting with you today. All the best if you're investing until we catch up again. Bye-bye for now.